Hello, Credit Suisse. My name is Ekaterina Briones and I am a junior studying accounting at Baruch College Zicklin School of Business. Today, I will use HOLT Lens software to tell you why I believe Kellogg stock at its current price of $69 per share will underperform. Kellogg's is an American multinational food manufacturing company that produces cereal and convenience foods. The company has the following reportable segments: U.S. morning foods and Kashi, U.S. snacks, U.S. specialty, North America other, Europe, Latin America, and Asia Pacific. Kellogg's is one of the leading companies in breakfast cereals, but there might be a declining trend in the largest cereal segment sales because of the continuing growth of breakfast alternatives such as snack bars and Greek yogurt. By looking at the CFROI chart, we see that Kellogg's has used its resources effectively to generate wealth in the past. Even though the company's returns are consistently being above its cost of capital, we see a downward trend in its returns since 2005. This indicates that Kellogg's is in its fading stage of the corporate life cycle. Currently, the market expects Kellogg's to grow at CFROI levels up to 14.5% in 10 years, which is higher than the industry average of 13.3%. I believe that this growth is overvalued and the competitive risks are ignored. Even though we see gradually declining operating margins over the past decade and asset turns over the past 6 years, the company's sales growth rates appear to be very inconsistent and are much lower than Kellogg's top competitors. Just as the declining CFROI levels, Kellogg's asset growth rates are expected to decline over the next 10 years as well. Based upon these figures, the warranted price is calculated to be $53.47 per share, which is far below Kellogg's current price of $69.39 per share, bringing us to a conclusion that the stock is 23% overvalued. Let's analyze further and assume a more optimistic scenario. Suppose Kellogg's can avoid its fading stage and we keep its CFROI levels at its current inputs of 14% and the asset growth at 5% rate. The result is that the warranted price agrees with the current market price, barely showing any upside for the stock, which shows a great potential of a downside risk. With the concerns regarding Kellogg's sales growth relative to its competitors, the fading stage of the company, and the potential downgrade risk discussed in this presentation, I advise investors to sell Kellogg's stock and instead look for stronger, more promising investments. Thank you for your time and attention.